Hello, and welcome to another episode of Desi Fire Podcast. Today, I have Nikhil Rungta with me. He is currently the CIO of LIC Mutual Funds, and he handles the equity part of it. What I know about being a CIO is probably what I've seen in movies like Wall Street, and I would much rather get a perspective from someone who does this on a day-to-day basis. So first of all, Nikhil, welcome to the show. And what does a CIO do, especially at a mutual fund?
Thank you for having me at your show, and thank you to your viewers as well. See, when we talk about CIO, the role is to oversee investment strategies and to ensure optimal portfolio performance. What exactly are those? These are big words. So I'll break them down into 5 points. First, investment strategies and asset allocations. CIO looks after fund management's investment philosophy. He selects the asset classes. He ensures alignment with investors' objective. Second point is portfolio management, overseeing fund managers, ensuring disciplined stock selection, and driving alpha generation. Third point, risk management. So he maintains a balance between risk and return. He ensures compliance with regulatory guidelines and safeguarding investors' capital. Fourth point is the team leadership and mentorship. He guides the research and fund management team to enhance the decision-making and improve performance. And lastly, stakeholders communication. He engages with various investors, distributors, and regulators to articulate the fund strategy and performance. Ultimately, my role is to ensure that our investment decisions create long-term wealth for investors while maintaining strong governance and risk management.
Fair. So the governance and the risk management part, and I believe a large part of the responsibility part of it, comes from the fact that you're managing public money. Here, prior to this, you were essentially managing a family office. You look after the funds for them. So what is the key difference between the two roles? Because yes, I think asset allocation or security selection or managing risk and returns, that is there in both the jobs, whether you are managing for one individual or for 100,000 of them. But what are the differences which exist between these two jobs?
So see, investment management definitely is part of both the roles, be it a family office or a mutual fund. But yes, the primary difference revolves around scale, structure, regulation, and investment approach. When I talk about scale and capital base, in family office, I was managing capital for one single entity with a long-term customized approach. The focus was on capital preservation, wealth transfer, and optimizing return based on family's risk profile. Here in mutual fund, I manage public money, as you rightly said, across multiple funds with diverse investment objective, which require broader and more scalable investment strategy. Coming to regulatory environment, family offices operate with very high flexibility and very few regulatory constraints. Mutual funds are very highly regulated with SEBI. It requires very strict compliance, risk management, and transparency in all investment decisions. On the investment horizon and risk appetite, a family office typically have a longer investment horizon, which typically takes concentrated bets. They invest in alternate assets and also hold illiquid portfolios. At LICMF, investments are aligned to funds mandate. It requires diversified portfolio, defined liquidity, and consistent risk-adjusted performance. When we come to decision-making process, in the family office, it often have a centralized decision-making process with direct input from the family members. In mutual fund, the investment decisions are institutionalized, backed by a structured research process, team inputs, and risk oversight committees. In terms of stakeholders engagement, in family office, interactions are primarily with the family, ensuring their financial personal goals are met. But in a mutual fund, I engage with thousands of investors, distributors, and regulators. It requires very clear communication on performance, on the strategies, and on the market outlook. Lastly, on the performance matrices, family office performance is just on absolute wealth creation, tax efficiency, and intergenerational planning. On the mutual fund, performance is benchmarked against indices and peers with a strong focus on alpha generation, on consistency, and risk-adjusted return. In short, managing family office is about personalized wealth management, while managing a mutual fund is about delivering consistent, scalable, and compliant investment performance for a large and diverse investment.
Fair. So when you're talking about the investment aspect of it, as an individual, how should I even think about equity investing, for example? Because I believe that's the area of expertise for you at LIC Mutual Funds. You are the CIO for the equities department, if I'm not wrong. So how should I or anyone listening think about equity investing?
So see, when we talk about equities, we need to focus on the structured long-term perspective. We have to focus on many perspective or we have to keep in mind many principles. First, think of equity as the ownership in business. When you buy a stock, you are owning a part of the company, not just a ticker symbol. Investing in companies with strong fundamentals, enable growth, and competitive advantage. Second is long-term wealth creation. Equities are best asset class for long-term wealth creation, outperforming other asset classes over time. Compounding works best with patience. The longer you stay invested, the greater the wealth accumulation. Third, and most important in today's market environment, volatility is normal. Stay disciplined. Market will always go through ups and downs, but short-term noise shouldn't distract you from your long-term goals. Successful investors stay invested during corrections and use dips as opportunities. Fourth, diversification and asset allocation is important. You don't pull all your money or put all your money in a single stock or a single sector. Diversify across industries, across market cap, across geographies. You allocate assets based on your risk appetite, financial goals, and time horizon. Important part is focus on quality over speculation. We focus on more of strong businesses with consistent earnings, good governance, and sustainable growth. We try to avoid chasing these hot stocks or short-term trends based on speculation. Risk and return go hand in hand. Higher returns comes with higher risk. We need to understand the risk-reward trade-off before investing. We always need to have margin of safety and avoid excessive leverage. And last couple of more points on the equity investing, systematic and disciplined approach. SIP is a great way, or systematic investment plan is a great way to invest regularly irrespective of market condition. Here we avoid emotional decision making. Fear and greed are the biggest threats to the wealth creation. And lastly, stay educated and stay updated. Keep learning about the market, economic trends, and corporate performance. Adapt your strategies, but stick to core investment principles. In short, equity investment should be seen as a journey of a disciplined long-term wealth creation guided by fundamentals and risk management.
See, the one of the ideas that you touched upon is that you need to diversify when you are investing in equity. I cannot just put 100% of my money in ITC stock or one company and hope it does well. So A is the diversification across industries and sectors, so to say. I'll give my money to you, boss. You manage it. I'll give it to a mutual fund and they take care of it because I know that I'm not good enough to make these decisions. But the other part, which often happens, is that maybe I invested in a Nifty 50 index, just as an example. Or maybe I invested in a large cap fund. Maybe because large cap funds are also very well diversified if you think about it from a sectoral perspective, or a small cap fund or a mid cap. So I understand the industry wise diversification. That makes sense. A, does it matter from an investment perspective if I'm putting my money in large caps or mid caps or small caps? And B, if it matters, then how do I figure out what is a good ratio?
Okay, so definitely this do matter. The distribution of equity investment across large, mid, and small matters significantly. It impacts your risk, your return, and volatility. The right allocation depends upon your investment horizon, your risk appetite, and market conditions as well. Say, large cap, when we talk about large cap, it's more to do with stability, lower volatility, consistent compounding. Mid cap, high growth potential, and moderate volatility. Small cap, it's high growth, high risk, and require patience. So there are a lot of consideration for allocation between these three. Your investment horizon, if you are say investing say for 10 plus years, mid and small cap can be higher. Your risk appetite, more small and mid cap means higher return potential, but also higher risk. Market cycle, mid and small cap tend to outperform in a bull market, but correct sharply in downturns. So, and there are also tactical adjustment. Say, if a market is overheated, then overweight large cap for stability. If the market corrects deeply, increase mid and small cap to capture recovery. A flexi cap fund can dynamically adjust allocation based on the market condition. So net, a balanced allocation across market caps ensures stability, growth and downside protection while capitalizing on different market cycle. But yes, if you ask me like what should be the allocation in numbers, if you have to put numbers in my mouth, then it would depend upon your risk appetite. Say if you are a conservative guy, then say 70% should be large cap and 30% should be mid and small cap. Balance would be say around 60% would be large cap, and aggressive should be 50 or lower than 50 would be large cap.
So to be really honest, most of the friends that I talk to, I thankfully am not in that space. And I'm sure even you would have noticed that at your fund that most of the retail portfolios are over the last couple of years have become mid cap and small cap heavy, so to say. So let's say if you look at equity portfolios, you're saying that potentially large caps could be 50%, could be 60%, could be 70% or somewhere in that range. Most folks that I talk to, and I know for a fact that number of people I talk to in a month, you probably talk to in a day, would the retail investors, people who are probably watching this, would have a much larger allocation to mid and small caps than 50% over the last couple of years. And the two things have happened over the last few months and few days. One is that they've fallen from maybe 15%, 20%, depending upon what you are looking at, from the peak values. There has been a lot of negative commentary against mid and small cap funds, which essentially started sometime in the middle of last year, if you think about it, when fund managers started saying that, okay, we'll not take money in small and mid cap funds anymore, or, you know, we'll allow SIPs, but we will not allow STPs. And there were various sort of restrictions which came in. A lot of funds started keeping a very significant cash positions late last year. And fairly recently, there have been comments by senior fund managers and Shankar and Narayan from ICICI included, who have advocated getting out or at least stopping fresh investments in small and mid caps. So whether it's a 30% number or a 50% number or an 80% number, as is the case of a lot of retail investors, my fundamental question to you is, what do you see, or what is your outlook from a mutual fund house CIO perspective? What is your outlook for mid and small caps for 2025? And what is your outlook for, let's say, 2030, so to say? And I believe 10 years and beyond would be very difficult to say what happens, especially in small caps and in a growing economy like India. But if you could just tell us about these two, that would be really helpful.
So say, if we talk about 2025, then we definitely remain constructive on small and mid caps. But yes, we are selective, constructive but selective. And from a longer term perspective, say 5 years down the line, we are structurally bullish on these two sectors, I mean both mid cap and small cap. But say as of now, we remain constructive. Let me give you some data points. Say when we talk about large cap, we talk about the top 100 companies as per market cap. When we talk about mid cap, the next 150. But when we talk about small cap, the actual MF definition is first company and beyond. Today, as per the latest data,
to 500.
No, it's 250 first and beyond. So that's the only definition. There is no micro cap definition available in India or from MP as of now. It's only large cap, mid cap, and small cap. So in small cap, from 250 first company and beyond, if I have to give you number of companies listed on our exchanges, it's 4,847 companies. And in that, say, as you rightly pointed out, it's from 251 to 500. That's the definition which investors, people like you, like us, we have made those definitions. Like these are micro caps. So say in India, if I talk about a company with a 501 rank, today that market cap is 11,300 crores. I mean, a friend sitting outside India, if I tell him that in India, $1.5 billion company is a micro cap, he laughs at me. So 5 year back, this number used to be less than 1,000 crore. At that time, we used to invest in that. Today, that's 11,300. See, it's not because these companies have become expensive. It's because a lot of new companies have got listed in the past 5 years. I'll just give you one more example. I mean, say, when a company gets listed in a large cap, say, just to give you a hypothetical example, it gets listed at a market cap of around 1,25,000 crores. The cutoff for a large cap is 1 lakh. So it becomes a large cap. So if that company becomes a large cap, the 100th large cap company becomes a mid cap. That becomes 101 rank. So if that becomes 101 rank, then 250th company, which is mid cap, that becomes 251st rank. And 251st rank means that mid cap company became a small cap because something got listed in large cap. So that's the thing which is going on in the market. A company gets listed anywhere in the space, the number gets added in a small cap space. And what we are talking about is that the market cap of small cap is rising. That's because anywhere company gets listed, a new company gets formed in a small cap space. That's why the market cap in small cap is rising. So that's the key reason why we remain constructive. And when we talk about the index valuation also, we talk about this Nifty small cap 100 or Nifty small cap 250 index. Hypothetically, let's assume the entire 250 companies become expensive. Then also my universe is 4,847. Let's remove that 250 companies. I'm still left with 4,600 companies. I just have to cherry pick those few scripts which will give me alpha, which will give me the ranking, the quartiles. I'm through.
Understood.
So that is what we are focusing on. That's the key argument on whatever 3-4 questions which you have in combined asked me.
Yeah,
But yes, there are a lot of opportunities available.
fair. I'm not going to leave you that easily now that I have you with me. The small cap part, which I wanted to clarify, the small cap index you are saying will be company number 251 to 500. However, a small cap fund essentially is allowed to invest from 251 to 1500, 2000, 3000, any listed company. So that essentially gives them that sort of an edge. Fair. So that's one part of it. The other part of it is from a 5-year perspective. And that's where, again, some of the argument has been that equity markets, the returns for equity markets will eventually revert to some sort of a mean. Now we can argue whether that mean is going to be 12% or 15% or what that is going to be. But because the last few years or last 2.5, 3 years, so to say, have been so phenomenally well for small caps as well as mid caps, and they have been really, really good for the Indian equity markets. I'm not denying it. The entire market has moved forward and we have all benefited from it. I'm very, very happy about that. So I'm not someone who is in the beer category or saying that the market should come down or anything close to that. I am fully invested in the market. But the idea is that if the returns have been really, really good in the last 2.5, 3 years, over a 5-year, 10-year period, if it has to revert back to mean to, let's say, something like a 12% or a 15% or in whatever value, the next 6-7 years or the next 5 years are going to be very, very bleak. And the returns in the next few years, they are not going to be the 25% CAGR that we have seen in the last few. What do you think about that? Whether they are going to be the 23, 24, or you still believe that, you can still safely assume that from a 5-year, 10-year perspective, from small and mid caps, you can still assume, let's say, a 15% or a 14%. It's not going to be zero like some people are saying that 10-year vision has been wiped out. So from a 5-year perspective, I understand that you are structurally bullish and stuff. But what would be the assumptions that you would be working with for the next 5 years?
See, the reasons are there are a lot of reasons why we are structurally bullish. There could be short-term cycles, and these cycles can be volatile. But the investors who focus on this quality, who stays invested, will generate significant wealth over, say, 7 to 10 year horizon. You talk about next 4 years or 5 years, definitely you need to look, you should not look actually over the past 3-4 years, the types of return which we have generated. But yes, let me give you one more data point there. If you look at the past 5 years return, then the returns have been very high. But if you add to that the previous 15 years, so when we are talking about 20 years return, is the same number which you are talking about, which you are asking, that normalized return. So a 20-year period have that normalized return. A 30-year period have that normalized return. These are short-term cycles. So definitely, when we go for these small and mid-cap, definitely our viewpoint or our investment tenure is more than these 5-7 years time horizon. And definitely, if I have to give you few reasoning as well, why these mid-cap and small-cap would outperform over next 7 to 9 years, then see, India's economic growth is what is driving this mid and small cap expansion. will be becoming, say, doubling our economy size over next 5 years, 6 years. This would be led by your consumption, your digitization, your manufacturing. A lot of new sectors like industrial automation, defense and renewables, tech services. These will come into picture, and these will become a new multi-bagger opportunities. Formalization and market share shift will from these unorganized to organized players will benefit these companies. If I talk about this historical trend, then this actually support this long-term growth focus. I mean, over the past 2 decades, many of these large cap companies were mid or small cap companies in 2000. Example, see, I don't want to take name, but say these are public numbers. Example is Bajaj Finance, Divi's Lab, PI Industries, Aisha Motors. These are all small cap or mid cap. So mid and small cap tend to outperform large cap over a longer period, but require patience due to interim volatility. What you are talking about next 3-4 years would be interim volatility. Neither I know nor my team knows what will happen over 3-year period. What we are focusing on is a deep down research, focus on the quality companies. Probably we get return earlier or a stable returns over next 5 years, 7 years, or it could be back-ended. But yes, more important is you need to be disciplined, you need to be patient and keep invested in every cycle.
Fair.
So these three things we keep in mind.
Fair. So I do have some user questions which had come in, which are broadly on the lines of, should we continue with SIPs or should we, put less money in asset allocation? I'll get to them. But before that, one thing that I, wanted to ask you is, before I get to these specific cases from a category perspective, and this is something I would really like to ask you as the CIO of a big mutual fund company, is the active investing versus the passive investing options which are there. I assume your company is probably selling both of them in some format or the other. So as an investor, it becomes very difficult for me. If I'm going in for an active fund, it becomes very difficult for me to choose which active fund I pick. Even for passive funds, there are so many options that have now come up. I don't even understand all of them. So that's a secondary level of decision making which is there. But at the primary level, should I choose an active fund? Should I choose a passive fund? Should I choose both of them? How do I decide about that?
Okay, see, this debate of active versus passive, I have already talked about this particular thing on a couple of forums. But yes, it depends upon your objective, market conditions, and fund management capabilities. Like when we talk about active funds, there is what is the opportunity to outperform the market. The fund manager aim to generate alpha by selecting stock based on their research, their market insights, and macroeconomic trends. Particularly in emerging economies like India, there are a lot of inefficiencies which exist. And this allowed the skilled fund managers to identify these misplaced opportunities and outperform and buying them and outperforming indices. Active fund works well in mid and small cap space where deep research can uncover these high growth companies. That's why we call these as hidden opportunities or hidden gems. When we talk about passive, it's more to do with low cost and market returns. It basically tracks an index like a Nifty 50 or a Sensex and provides you, say, market returns with minimal expense ratios. These are ideal for investors who prefer low cost investing and believe in long-term growth of the market without active interventions in them. The passive works best for large cap spaces where market efficiency make it harder to generate consistent alpha. Which one is better as one of your question? For an experienced investor seeking alpha, active funds make sense, provided they choose a fund which has a strong track record or a fund manager who has a good track record and a disciplined investment process. For a cost-conscious investor with passive investment approach, index funds or the ETFs, combination of both also works well. Core portfolio, say passive funds, your satellite portfolio, active funds. Lastly, on the Indian market context, it favors active management because India is a growing economy with evolving sectors creating stock picking opportunities. Unlike developed market, indices in India are still evolving. It's giving active managers an edge in capturing these sectoral trends and high growth opportunities. However, as market mature, passive strategies will gain more traction, especially in large cap. Conclusion, active funds can outperform but require skill, discipline, and strong research. Passive are cost-effective, simple, and ideal for broad-based market exposure. Investors should blend both strategies based on their risk profiles and investment goals.
Nikhil, before we wrap up, I would like to ask you a couple of questions which have come in from our users. First one is, I'm 50 years old. 75% of my equity exposure is in large cap. 15% is in international equity. 10% is in mid and small caps. I have two SIPs going on right now, one for a mid cap fund and one for a small cap fund. This is to fund my son's higher education and he is in class 6th right now. So, should I stop my SIPs? I'm assuming his SIPs are only in mid and small caps because that's lesser in his portfolio. So that's what he has started. And so class 6. So roughly at least 6 and potentially 10 more years maybe for higher education could be masters as well. So a 6 to 10 year window. So would you recommend him to stop his or maybe redirect his SIPs to something else instead of these small and mid cap funds?
Since the mid and small cap SIPs are meant for the investors' sons' higher education, which is about say 6 to 10 years away, first continue with SIP as of now. Your mid and small cap are volatile but offer very good growth over the long term. Since the investment horizon is 6+ years, continuing SIP allows you to invest or to get benefit from the compounding and rupee cost averaging. However, as the goal nears, say 3 to 4 years before withdrawal, you should start reducing equity exposure and gradually shift fund into safer assets. Gradual de-risking plan should be there. Something like say 3 years before college or 3 years before this higher education, start shifting 25 to 30% of your accumulated wealth or corpus from mid and small cap to debt fund or balanced hybrid funds. 2 years before college or before higher education, move around 40 to 50% into safer assets. And say final year before the higher education, keep only a small portion in equities with most of the funds in liquid or ultra short-term debt funds for safety. We need to monitor the market conditions as well. If the market condition turns overheated over next 2-3 years or 4 years, consider booking some profits early. If there is a deep correction, don't panic. Equities tend to recover over time. In all conclusion, continue with the SIPs for now, but have a plan to gradually shift to safer assets as education goal nears to avoid last-minute market risk.
So essentially, continue with the SIPs, nothing wrong with that. But over a long term, let's say if it is 10 years away when you need the money, maybe in the last 3 years, 4 years, start reducing the equity percentage, follow a glide path.
Yes.
Okay. So yes to SIPs from Nikhil. His question is, I'm an early retiree. I have around 50% of my equity portfolio in mid and small cap funds, whereas the other half is in flexi cap mutual funds, which I've noticed are large cap heavy right now, which I believe most flexi cap funds are large cap heavy right now. Should I sell my mid and small cap funds and switch them to flexi cap or a large cap fund right now? So again, very similar query, but instead of fresh money is talking about an existing exposure, which is fairly large exposure. So should that be switched or get out of small and mid caps?
See, the person is an early retiree. We also aspire to be early retiree. But since he is already an early retiree, his portfolio should focus on growth, stability, and risk management to sustain the retirement years. So the approach would be, currently it's 50% in mid and small cap, high growth potential, but high volatility, 50% in flexi cap, which are also large cap heavy. This provides flexibility, but still has mid and small cap exposure. Given that mid and small cap can be highly volatile, having 50% exposure in retirement might be risky unless the risk profile or the investor have a very high risk appetite. Should you switch to large or flexi cap fund? Yes, but gradually, not all at once. Here is why, because mid and small cap tends to outperform in the bull market, but can see deep drawdown in correction. We have already seen that in the past couple of months. In retirement, you need to have a downside protection. Reducing risk exposure makes sense. Lastly, percent shift to large cap might say 100% shift to a large cap from a long-term perspective will reduce your potential of growth over a longer term. So what should I suggest? It would be, say, reduce mid and small cap exposure from 50% currently to 25 to 30% over time. Increase allocation to large cap or flexi cap funds, which are large cap heavy for more stability, and consider adding balanced advantage fund or dynamic asset allocation funds or multi-asset allocation fund for risk management. Gradually shift this over next 12 to 18 months, especially if markets are strong, book partial profits in rallies, and wait for some recoveries before shifting large amounts if there is a correction. Final recommendation, yes, since you are a retiree, reduce mid and small cap allocation, but don't exit completely. They still
Yeah,
provide
so
you
it's
long-term.
not sell everything lock, stock, and barrel is not really
I don't want to
something.
use those things, those
I'm
words.
not going to get that out from your mouth that sell everything. From what I could understand is, A, you are fairly constructive for 2025 and fairly structurally bullish for a 5-year, 10-year period. B, if you are following the SIP route, you should continue following the SIP route for small and mid caps. It's not really something. And C, even for the mid and small cap thing, until and unless they form a huge chunk of your portfolio, if they are maybe at a 15, 20, 25 odd percent, stick to it. No need to sell lock, stock and barrel. I think, would it be fair to say that if I put the title of this video as Nikhil Rungta is still very bullish on mid and small caps, would that be a fair assessment to put as the title of this chat?
Rather than that, bullish on small cap from a long-term perspective, because we need to use that word long-term. See, what
Fair.
people are thinking
Fair,
is,
fair. So, Nikhil Rungta still still bullish on small and mid caps for the long term. Yeah,
yes.
I will be using that. And before we wrap up, you can maybe in some 30 seconds to a minute, can you give us the core of your investment philosophy?
So my investment philosophy is centered around quality, patience, and risk management. I believe in investing in fundamentally strong businesses with sustainable competitive advantage, high ROC, and strong cash flows. Prefer long-term compounding over short-term speculation and focus on sectoral tailwinds, scalable businesses, and management quality. I look for growth opportunities. I emphasize valuation discipline to avoid bubbles. Market cycles are inevitable, so I maintain a balanced approach, staying invested through corrections and using them as opportunities. Ultimately, consistent risk-adjusted returns, not just high returns, will drive your long-term wealth creation.
And on that, I sincerely hope all our listeners also end up creating long-term wealth. Hope you like this video. Please remember to like it on YouTube also, and remember to subscribe to our channel.